It says 29 for me.
Isha, I think you should start.
Okay. So good day, everyone, and welcome. Thanks for joining today's session on value creation and private equity, a topic you'll recognize that sits at the heart of driving sustainable performance and investor returns across portfolios. My name is Ish Joshi, and I'll be your host and a speaker at this session. But before we begin, a quick bit of housekeeping. We'll have some time for Q&A towards the end. So please drop your questions into the chat as we go, and we'll try and cover as many of them as we can. Also, the attendees will receive a copy of the presentation slides following the webinar. A little bit about me. I'm a change expert. I have seen many businesses fail because they are underinvested in making change happen. So my role in this webinar is to set out our 5-pillar approach to value creation that drives that change, and going forward, work with you to build change momentum in your firms. With that said, let's now just take a quick minute to introduce ourselves. Can I pass the mic to you, Subhas?
Ish, thank you so much. Well, good to be here. I am Subhash Roy, CEO of ICAG Partners, and I have over 30 years of experience of working with some of the largest assets in the globe, working with some of the large top-tier private equity firms on helping them to create value, increase market capitalization, turn businesses from loss into profit. And one thing I'm looking forward from this webinar is to really hear my co-presenters' perspectives on how to create value and to really engage into a thought-provoking discussions. Maybe I pass it on to Sebastian for him to introduce himself.
Yeah, hi everybody. My name is Sebastian. I'm a B2B software investor in Verdane's investment team. I'm focusing most of my time on GRC, RegTech, capital markets tech, an area that is clearly also impacted by AI, as many software categories as of today. And yeah, looking forward to an interactive discussion.
Thanks, Sebastian. My name is Gopal Kuchibutla. I come from a Big Four consulting background, 35 plus years of experience. I've done lots of work, in terms of transformation of the operating models and finance functions and technology functions and so on and so forth. I'm going to be talking today about, the value creation maximization for, PE firms and their portfolio companies. Ish.
Thanks, Gopal. With that, I'm delighted to hand over to Subhas Roy, who will kick us off with some opening insights on current value creation trends across the PE landscape. Subhas, over to you.
Thank you, Ish. What we have on this page is effectively a culmination of a annual survey that we run with about 150 senior investors internationally. And the experience has been really interesting, overwhelming, I think I would say, for us here in ICAG as practitioners. We see on an average every private equity firm losing between 10 to 100 million US dollars of value creation opportunity over a period of its investors' gestation. So that could be between 3 to 5 years. Really, really large number in terms of opportunity lost out. When we start to really delve down a bit into detail, we see 53% of value creation failures stem from poor execution performance. Often management knew that things need to be addressed. That could be at the front line in the marketing sales, could be at the product management, pushing out new ideas or new technology couldn't happen in time. 70% in our experience of M&As actually failed to deliver the desired values due to unrealistic, often ambitious targets being set, cultural differences between various management team, differences between board and the management and the people who are actually doing the day-to-day job, often poor execution, right? And the last point is really important on this page. Only about 45%, so less than half of the revenue enhancement values are effectively realized by the private equity firms themselves without expert support, right? And I think that's where the folks like us from ICAG, from Verdane comes in, right? We're here to help you foster your investment. We help you deliver your realizable concerns, right? Let's go to the next page and then take a look at some of the key things that we often see our private equity clients misses out. So if we see on this particular page, we're talking about 6 major value creation gaps. Now, these are coming from, again, that practitioner's point of view. We work on the coal face of most of the companies and with their private equity owners, try to help re-engage with the market, try to help connect between products, technology, and marketing to make magic happen. And from there, we often see that businesses are unable to shift from the growth mindset to the profitability mandate. There's a big difference between a growth mindset and a profitability mandate. A growth mindset I would define as a point where a business in the initial years, and that could be a financial technology business, that could be a regulatory technology business, it could be a GRC, it could be a TMT business, effectively looking at growing presence, having no more number of clients, not really looking at the bottom dollar value in terms of profitability. Now, that cannot be sustained for a longer period of time. That could be good for the first 3 to 5 years of your existence as a fintech, as a regtech business. But as you progress, as you mature, you need to be able to turn into profitability. So how do you turn yourself from a growth mandate to a profitability mandate where you're actually returning your money to the investors, right? Thereby you're proving your worth and you're effectively sustaining your future. That's really important. And I think that's a major gap. There's often big gaps we see between strategic plans. For example, we want to triple our revenue. How are we going to do that? To sort of execution plan often fall short. We often see technology drag, data integration issues. We have been working with so many businesses. One of the businesses I would like to mention here, a big GRC regtech business. They have done 7 or 8 acquisitions in the last 2 years. So really fast growth, but really big integration issues, really big surmounting cost issues, which is difficult for them to come back to profitability. This business hasn't returned money yet to its investors. And then on the top of that, unable to win new clients or maximize return on investment. Now, we know we are in a tough economic environment, geopolitical climate, right? Winning a new client within banking, within financial sector in particular, where we operate, can take anywhere between 12 to 18 months. Now, do you really go and win every RFPs on the street? Perhaps that's not the answer. Perhaps the answer is you need to really look at your books of accounts, the clients, customers you have, and really deepen the relationship and stretch your presence in those organizations, or keep a balanced hybrid strategy between go to market and winning in your existing market, right? And that also then stems to leadership, cultural changes, talent, the type of talent you need to sustain growth and scale rapidly yet. And then finally, the chasm here is the shifting sand of regulatory, geopolitical, and the policy landscape, which are ever changing. And obviously, with the Iran war going on in the last 2 weeks, with the Ukraine-Russia war going on, these are real challenges that we all live with. So what we do from an ICAG perspective, working with senior investors like yours, bring all of those gaps and understanding underneath to really create your path to maturity, to really create your path to create more value and market capitalization. Ish, I'm going to hand it over to you, and perhaps let's go to the next page and see what more others want to add.
Thank you. I think it would be good on that to get Sebastian's views as well and perspectives before we set out the 5-pillar approach. So, Sebastian, can I ask you maybe from your perspective, what have you seen?
Well, I would say all the challenges and value creation gaps that were identified on the previous page are resonating with what we're seeing in our portfolio and also within new investments. The one area where we probably spent the most time on post both pre but also post deal is on management culture, leadership, and also board composition, because this in the end helps drive and closing some of those value creation gaps. And when you have not the right team in place, then it becomes difficult. So this is one key area for us of focus.
Excellent. Thank you. With that said, let's look at the 5-pillar approach. So the 5-pillar approach has 5 areas, if you like, which typically we look at when we are on a value creation journey. Let me set this out for you very briefly. The first one is about delivering growth. And delivery of growth, this would mean the accelerating the top line performance through sharper commercial strategy, pricing strategy, sales force enablement and effectiveness, and really bringing digital go-to-market innovations which drive that growth agenda within the PE firms or portfolio firms within the PE. The second, of course, is then operational excellence. Operational excellence, this is about optimizing processes, cost structures, and building an efficient and effective operating model and realizing savings and gains from doing that. This is, of course, closely interlinked with the third pillar, which is technology and data. This is all about bringing into play modern digital platforms, lots of automation and AI initiatives, which will drive that step level in productivity and help operations become more efficient and effective indeed as well. Another area is financial engineering, and this is different from financial transformation. Financial engineering is all about optimizing the business finance, if you like, the capital structure, the liquidity, the cash conversion, if you like. And in all this is done to balance, if you like, the balance sheets, the capital in play, with an aim to enhance investor returns and deploy that capital more productively. And finally, the all-encompassing change management and leadership pillar, which is so very important to get right from the start. This is about aligning, having the proper leadership, the proper culture, the growth mindset. The need for urgency is high in these value creation journeys, and so that mindset needs to be absolutely natural in the leadership that is installed to take the firm or firms forward, and then of course installing the right talent as well. And so then these five pillars, they sort of are connected, as you can see, and the value creation journey through every lever from strategy to execution needs to work in harmony to deliver that measurable growth and enterprise capabilities that are required to take a firm from the point of acquisition to increasing its value over time. That said, let's dive in and take a look at two industry examples, ones which we've been close to, and understand what levers they use to create value in their portfolio firms. And for that, can I invite Subhas to kick us off with some details, please?
Thank you, Ish. This is tremendous. I mean, look, we work with a variety of organizations, really interesting ones. So it was a rather difficult one, sort of, just to pick up two examples when you had asked me, a couple of weeks ago to do that. So I think here are my two examples. One is, sort of very close to our organization, a London-based large private equity firm, which is one of the market leader in investing in financial sector, but also in the wider TMT, wider telecommunications, sort of media type companies. And we have worked with them for the last sort of 2 odd years. Back in 2024, early 2024, we helped them to invest majority investment in a mid to large GRC, governance, risk and control technology platform, headquartered in Europe, having global presence, and sort of having a deep investments into capital market risk and regulatory compliance type solutions. Now, the key issues, I think, sort of three issues, or if we look at the five pillars here, sort of three of the pillars really strike me here, and that we have addressed, working with this private equity firm. First, as Sebastian pointed out earlier in the call today, is the leadership, right? Now, that organization at the time of purchase were founder-led, which was great. But often they missed revenue targets. Often they missed out on large RFPs. Often they missed out on really creating a presence, a calibrated presence, including regulatory liaison and so forth, right? So we worked with the management and we worked with the private equity investor here to really bolster, and I would say really escalate and improve the quality of the management. Got in a new head of product, got in a new head of regulatory affairs, who were had years of experience of raising technology, but in a regulated environment within capital markets. We also then worked across their technology and data. So the point that you made, Ish, in terms of how can you instill leading edge technology innovations, for example, low code, no code, which is really important onto GRC design and delivery going forward, but also going to a more integrated model where the clients of the GRC technology platform can actually integrate, for instance, their operational risk management with IT risk management, cybersecurity, and data protection, right, which are not there. So we had to go through, look at the controls, and look at how those products have been marketed, and really designed the back engine, right? So that's number two. And the third one was a sheer operational excellence. So really looking at their middle office, really looking at the back office. In terms of middle office, really pulling forward the relationship between the product and the marketing and the customer services team, ensuring they're working as a single team, ensuring when they're winning a new client, they're going together as a single team, understanding the client pain points and addressing at the same point in time. And the result was amazing. I mean, we have until today has delivered, we think, 1.5 times more, so 150% more market capitalization in terms of realizable values. So we not only have a very satisfied senior investing firm, a large London-based private equity firm, but we're actually demonstrating that by taking the right actions at the right time, you can really make a world of difference, not only for yourself, financially, commercially, but actually for the end clients. Because put it this way, this GRC technology firm have now been scoring anywhere between 9.5 and 9.8 in a scale of 0 to 10 when it comes to Net Promoter Score or NPS. And I think the previous experience before this acquisition, before ICAG's work, was somewhere between 7 and 8. So that's been wonderful as well. The second one is again a very large Nordic-based private equity firm, and again ongoing work. So it's a difficult choice, but this is a very large, regulatory intelligence technology, regulatory technology firm. That we have worked with this private equity owner, again a majority owner, to really identify what are the new innovative techniques, what are the new technology, what are the new propositions they can really develop, and that could be really connecting between regulatory intelligence, control automation that often banks and the tier one financial services institutions will often miss. And this has been such a great experience, I think, for ICAG, for us, but I would hope, for the investors and for their RegTech asset as well, because we have seen this company, this particular firm, revenues, their total account annual recurring revenue has been doubled. But not only that, we see clients that might have gone in the past coming back saying, okay, we have heard the great work that you've been doing. Can we see, can you give us a demo? And I think that has happened because a combination of those leadership, technology, and data operation excellence, but also sheerly delivering growth mindset. So really thinking about, okay, what's the horizon of the change looks like in terms of regulatory spectrum? Then can I change my product? Can I redesign my propositions to the market so that I am the first one in the market to deliver when a change happens from a regulatory or risk perspective? So those are my experience. But let me invite Sebastian. And Sebastian, you're very senior investors best here in Europe with international experience. What are you seeing? I mean, where do you think there are value creation lessons that we can share, with the colleagues who are dialing in here today? Sebastian?
Well, I guess there are probably many lessons to be learned for our industries across all those 5 pillars. But I guess particularly with regard to RegTech, capital markets tech, etc., especially when it comes to deep and heavy products, it's very important to just develop a long-term vision for a product and also have the stamina to go through long development cycles combined with long sales cycles. And this needs a deep understanding of the industry. And we also have made a good experience with you, Subhas, and the entire ICAG team with this deep financial services sector experience and expertise, not only on the product side, but also on the decision maker side and how those organizations really work. So I think one lesson for us as we looked at many GRC and RegTech firms in the past, it's not a standard workflow product in most of the cases. It's something that solves real business pain points in an industry that is still pretty manual in many of those instances. And so understanding really what the product does and that it delivers the solution and doesn't create any noise and delivers solutions at an accuracy level that is reflective of the necessities of regulated industries is very important.
Thank you. That's wonderful. Thank you so much.
Thank you, Subhas and Gopal and Sebastian. Can I now invite Gopal to set out how we create value for you and what is the journey we follow?
Sure. Thanks, Ish. We have a phased approach that can fully support PE firms as well as their portfolio companies on their value creation journey. Phase one primarily looks at assessing the operating model of the firms and the portfolio companies, identifying the value creation opportunities, especially the quick wins, and then designing the interventions that are required. And then we go on to kind of implement those quick wins in phase two. And typically phase one and phase two we can finish in about 6 to 12 weeks, depending upon the nature of the businesses that we are looking at. And then phase three, we start looking at some of the larger initiatives, which kind of can lead to transformation of the companies as such. And then finally we look at putting in place the interventions and implementing them so that the operating model transformations can happen, and we are able to kind of scale it as the business grows, as well as sustain it in terms of continuous improvement and so on and so forth. So this is the full four-phased approach that we have, and phase three and phase four can be taken up, will take roughly 6 to 9 months, depending again upon the interventions that we choose to focus on. So it's a full-fledged approach, and we have seen lots of value that we could create for our clients. Thanks, Ish.
Excellent, Gopal. Any perspectives from you, Subhas, before we move on to?
Happy to share some perspective. I mean, look, as my presenters, co-presidents have said, I mean, we continue to do this, perhaps done this multiple times in the last few years. We bring in a hands-on practitioner's perspectives, right? I mean, look, we have people here in the team who actually have been on both sides, right? So that means, we have helped others to grow, but often I myself included, having situations where I needed to work on the investments to grow those businesses. So that is a significant differentiating factor, I would say, for us than you would go to anybody else in the market, right? On the top of that, we always deploy a very senior team, senior executives team, who has at any point in time, I would say, greater than 100 years of consolidated work experience. So that creates a lot of difference. You end up working with senior people who doesn't mind getting their sleeves up and actually doing the work. So you talk to the people, before you starting work ICAG, you then, end up working with them. So that's again, another significant differentiating factor. And then finally, we're always listening. We are transformative, and we believe and we adopt a collaborative approach, right? We bring in the best that can be offered, but we're always listening to you because we know heart and heart that everyone's different, right? And I think that sort of comes out to Gopal's point. The initial 6 to 12 weeks is an important one for us because not only we're then able to diagnose areas using those 5 pillars that we have talked about, that where we can really pull and push various mandates and actions, but then actually identify and deliver those quick wins. So what you get in those initial 6 to 12 weeks is not only a set of bullet points or set of points like this needs to be done, but actually are there quick wins and can actually go and deliver it. There have been multiple private equity firms and their assets who have benefited within 6 to 12 weeks from some of the quick wins. That could be unfolding, unlocking those connectivity between product, technology, and operations and market. That could be unlocking very senior client relationship at the board level, at the management level, that often this particular technology organization were unable to reach, and through our senior network we could make that happen. And that could protect yourself or your asset from losing a business or from winning a new business, right? So all of those quick wins are there in the first part of the work that you get from ICAG, which I think is a significant difference. Then you go to somebody else and you just perhaps spend initial 6 to 10 weeks just talking and understanding what needs to be done. We can actually get things done in that period. I think that's a big difference. Ish, I'm going to hand it over to you, and let's see what more we have to share.
Thank you, Subhas. That's great. We have a little bit of time for Q&A, so I'd suggest we move to that. With that, I'd like to invite our speakers in a freewheeling chat to address some interesting questions and answers with real life experiences, maybe in a discussion format. And I thought, Gopal, perhaps you can set us off, get the ball rolling by setting out the 2 top questions you think PE firms are likely to be addressing in their value creation efforts, in the current landscape.
Thanks, Ish. I think the first question all of us would like to kind of address is, what do we do about AI, artificial intelligence? It's the elephant in the room. How do we deploy it? How do we get rewards from it? What are the risks involved? So I would like to first ask Sebastian about his perspectives on effectively using AI in PE firms as well as portfolio entities.
Yeah, so the experience we have making so far, it starts all at the top and also with the culture of a company. We need to be all paranoid. The developments are just moving so quickly, and the benefits one can get out of those technologies are frightening at points. But on the other hand, there are also big opportunities when it's embraced, and so it's about a culture of trial and error and adopting both internally in processes, but also within the products. What many people from our perspective haven't realized yet is that it also fundamentally changes the economics of certain products, software products that are then becoming data and AI products. When you need to run those large LLMs at scale, in an industrial scale, in a data environment, and gross margins in the industry will change over time. This may depend more on the kind of software you are developing and the end markets, but it's just different for light workflow software vis-a-vis a software that delivers real value on data. And hence there will also be a bifurcation from our perspective in the market when it comes to valuations. There may be a more ambitious thesis that would say, well, the new 20 times or 25 times EBITDA is rather 10. And then on the other hand, we will also see businesses that are being valued at 40 because they are just AI leaders and can tap into a much larger TAM.
Okay. Thanks, Sebastian. Subhash, your perspectives?
I mean, look, that was great to hear from Sebastian's perspective. From me as a practitioners, I would say 3 stripes across people, process, and technology, or AI view, because I think it's encompassing, it's across everything. In terms of people, look, I mean, we work with multiple companies which are investing heavily onto AI today, and you know that, Gopal. I think it's really important to have people and increasingly understanding of the people that you have in the business about embracing AI. You are in a situation today that you cannot avoid AI. So not having angst, but actually go close to those AI solutions. Don't get scared, because often it can be, and really understand, what are the positives, but also what are the negatives, so that when you actually are able to pull the levers, which one not to press or which one to press, right? So that's the people side. The process side, as Sebastian pointed out, really important to go front to back to front in terms of your business and understand which part of the businesses, and that could be market-facing workflow, that could be your solutions where AI can make solutions. That could be potentially large language model, that could be sort of involving agentic AI type solutions as well, right? And then finally, your technology stack. Now, this is significantly different because I think on the technology stack, you need to have minimum 24 months to 36 months view, I would say. So you need to sort of think about how to protect yourself 3 years out, because that could be potentially investor horizon here. And what could be potentially playing out in 3 years' time. So invest into those AIs that you sit in 3 years' time will keep you ahead of the game. Also, at the same point in time, think about how to secure your IP, intellectual property from others, sort of other companies using the same AI. So it's sort of a dual approach within technology.
Absolutely, absolutely. I think we just 1 minute left. So finally, what do you think will be the involvement of, let's say, the PE firm executives, portfolio executives, when we take up these transformation initiatives? Would they need to spend some time on this, taking that time away from what they regularly do, or what are your thoughts, Subhash, on this?
I think absolutely has to be. I mean, one of the key reasons we have somebody very senior like Sebastian on the call, because this is for the future. I mean, if you really want to keep increasing value of your businesses and market capitalization, you need to be able to not only invest into technology, but be very well informed. And Sebastian, anything to add, please, in the next 30 seconds?
No, absolutely. That's a complete answer.
Thank you so much. Thank you.
Thanks, Sebastian. Thanks, Subhash. Ish, back to you.
Excellent. Thank you, speaker panel. That was great. I hope the attendees found this rapid session quite useful. Thank you all for joining today's session. We need to draw it to a close. As I said, we will be mailing out the slides to all the attendees. It was a pleasure to have you with us and listen to the rich discussions here, the sharing of insights. We appreciate your time and engagement, and we look forward to engaging with you one-on-one as we go. With that, wish you continued success and see you another time. Bye for now.
Thank you.
Thank you. Bye-bye.
Thank you.
Thank you.